Are you a below or above average Australian investor? I've analysed $2 billion worth of portfolio performance data to see what the average Australian portfolio looks like and how it's performing in the market. We're going to look at things like portfolio size, whether people who just pick stocks outperform people who just buy ETF index trackers, and at the end of the video, I'm going to show you what the top 10% of the portfolios are doing that the rest are not. My name's Navexa. I'm the founder of Navexa, which is a portfolio analytics and tax reporting platform based here in Australia. I have the privilege of looking after thousands and thousands of portfolios of investors all around the world. And today we're going to look at a couple of thousand portfolios that are specifically Australian-based portfolios that have more than 5 years worth of data. In this sample size is about 2,800 portfolios, and it's going to give us a really interesting look at what the average Australian is doing and what the best performers are doing. So the first piece of data I want to look at is the portfolio characteristics of the average Australian portfolio. The numbers I'm about to give you is the amount of value in each of these categories for the average Australian portfolio. So interestingly, and maybe not surprising, 68% of the average portfolio value comes from direct ASX stocks. So it's no surprise that Australian investor portfolios have a lot of value in ASX stocks because that's that home bias at play. Most Australian investors just invest in Australia. And it's the same all around the world. US investors also just invest in the US, and everywhere you go, it's pretty much the same story. Number two is only 13% of the average portfolio value is from ETFs and managed funds. Now, I personally would have expected that to be a lot higher, but it seems that the average Australian portfolio is still picking those select stocks to put most of their money into. The third category at 10.6% is US stocks. So that's 10.6% of the average portfolio value is coming from US companies. That's not really a surprise as well, because most Australian investors, if they're going to venture out of Australia, typically go with US markets. Then we have 4.2% invested in other. So that's other markets, potentially Europe and Asia, that kind of thing. And then 4% of the portfolio value on average comes from crypto as well. Now, crypto is starting to feature in a lot more portfolios that we see in Navexa. So I'm not surprised it's only 4% of the value. I think what we're seeing is a lot of portfolios are getting crypto, but still only a very small amount in terms of the value. The next piece of data is the average portfolio size of the average Australian investor is 671,000. Now remember, this is from Navexa portfolios. This isn't a sample across all types of investors. It's particularly the people who like to track their performance really accurately. We also looked at the breakdown of portfolio size. So we've got a few brackets here. Interestingly, portfolios under $10,000 performed the worst on average with a 2.6% average return over 5 years. Now that's not too surprising because typically you'd expect if you have less than 10 grand invested, you're very much in that beginner category, and beginners don't know what they're doing. So it's no surprise that they're getting a very low return at that level. But in saying that, as the portfolio value starts to get over 10,000, you can see in the 10 to 50K bucket, which is 17% of the investors in this data set, the return jumps up to 11.7% per annum over 5 years. Now, that's a pretty significant jump. And then if we scan down all the buckets and we get to the over $1 million bucket, that's 17% of the investors in this data set. They're doing an average return of 21% per annum. Now that's pretty damn good. Your portfolio compounding at 21% per year skyrockets the amount of money in that portfolio very quickly. So the key finding there is that the larger portfolios are performing better. Now that doesn't really surprise me because let's say you don't have $1 million invested right now. Imagine having $1 million invested. You would keep your eye on that pretty damn close to make sure it's performing well. When you have that much money exposed to the market, you're going to be all over that and making sure that it's doing the right things. So I think the portfolio value is largely a proxy for skill. The more skin you have in the game, the more serious you're going to take it. At least that's my theory on why that number is what it is. The next category we want to look at is how many portfolios are just domestic versus just foreign. and how many are mixed and what is their average return like. So portfolios that are domestic only, that's 22% of investors, and they're doing an average return of 17.1% per annum over 5 years. Now that is a pretty good return. That is smashing the benchmark, and that is people who just invested in the ASX here in Australia. The second category, which is 35% of investors, is the mostly domestic. So that's where more than 70% of your portfolio is in ASX stocks, and the rest can be everything else. Those people, their return drops quite a bit, down to 10.6%. The mixed portfolio, which is a quarter of the investors in this data set. Now this is people who don't have a strong swing to ASX or to foreign. It's kind of, 50-50. They're achieving a 14.4% average return. And then jumping down to foreign only portfolios, so that'd be an Australian investor exclusively invested in the US or Europe or wherever it might be, they're doing a very similar return to the domestic only at 16.9. So it's about the same. So I think what we can see there is people who are focusing on just one market seem to be performing better. And that could be, this is just me theorizing, but it could be if you're just invested in the US, for example, all you've got to worry about is US news, what's the US government doing, what's US interest rates doing, how's that impacting US companies. And similarly, if you're just invested here in Australia, you can block out everything else and just worry about that one thing. Maybe that's why they're outperforming, whereas a mixed portfolio, you got to kind of check the news here, check this here, what's that government doing, what's this one doing, and it can be all over the show. Now, the next thing I wanted to look at, we always hear about, buy and hold investors outperform active traders, and patience beats people who are impatient, and all the good Warren Buffett quotes suggest that that's the case. So let's look at the data. So the way we determine a buy and hold investor is using a turnover ratio. So the average value traded divided by the average portfolio value. And if it's more than 20%, it means you're an active trader. If it's less than 20%, it means you're a buy and hold investor. So the big reveal is that a buy and hold investor, of which 31% of this data set qualified for that, on average was doing an 18.3% per annum return. Very good. From the active traders, which was 69% of the data set, which is quite a big portion, they only achieved a 12.2% per annum return. Now in isolation, 12.2% per annum is pretty good, but when the buy and holds are beating that by 6% and doing 18.3 over a decade or 2 decades, it's a significant amount of money. Not to mention that this doesn't factor in the actual money you keep, which is the after-tax money. And as we know, active trades, every time you sell as a CGT event, you're paying tax. That's not even factored in. So I'd wager that 12.2% is actually quite lower in real take-home money terms. The other interesting part there was that 69% qualified as active traders. Now, I suspect a lot of those people wouldn't classify themselves as an active trader. I think it would come down to panic selling, people with no strategy buying something and then realizing, oh, that wasn't for me, and then selling it. I think they've inadvertently qualified themselves as an active trader when they'd probably, if you ask them at a barbecue what type of investor you are, they'd be, oh yeah, I buy and hold for the long term. The next category for the average Australian investor was stock pickers versus fund pickers. Now, funds, we're covering ETFs and managed funds as a fund. And what we can see from the table here is that stock pickers only, so they have 0 funds, no ETFs, that was a quarter of the investors in this data set. And they were doing an average return of 15.5% per annum over the last 5 years. And that's pretty good. Then we have mostly in stocks, so that's greater than 70% in direct equities. That was 39% of investors, so quite a lot. And they were doing 11.9% average return, so quite a bit less. Now the mixed portfolio, so some stocks and some funds, performed the best at 15.9% per annum, and that was around 29% of the investors. It doesn't surprise me seeing the other data because we saw the makeup of value earlier, where there was a large value in direct ASX stocks and then a lot less in ETFs. It kind of makes sense that the mixed portfolio is doing the best. We should note the ETF/fund only people, which is only 5% of investors, they were doing a 15% per annum return as well. So pretty good. So that brings us to the big reveal. What is the average total return across the average Australian Navexa portfolio? The answer is, drumroll please, 14.1% per annum. And to put that in context, the ASX 200 did roughly 8% per annum over the last 5 years. That number I'm really impressed by. 14.1% is a very good per annum return. And I think it comes down to the type of customer that uses Navexa. Obviously, if you're using Navexa, it's because you take tracking your performance really seriously, like I do, which is why I built the product in the first place. But I think it's the characteristic of wanting to track it so that you can manage it and improve it really shows in that number. Now, we can't take the credit that because you use Navexa, you achieve this really good return. But I think, again, it just comes down to the kind of person who takes tracking seriously is the kind of person who's putting their money in places strategically rather than, FOMOing in and out of different stocks. And I think it's a number that if you are a Navexa customer, you can be really proud of if you're in that kind of bracket. Remember, that is across 2,738 portfolios. So that is a really good average. Now, the part that we've all been waiting for, which is super interesting, is what is the top 10% of those portfolios? What do they look like? What kind of returns are they achieving? What's the makeup of their portfolios? So without further ado, let's get into it. So looking at the portfolio characteristics again, we're going to go through the same categories. The holding type breakdown. So this is the average value of the portfolios and where it's coming from. So interestingly, 67.4% of the value is in ASX stocks. So that's really similar to what the average investor is, which I think was around 68%. It's almost exactly the same. But where the differences start now is the second category, which is US stocks. And we have 17.6% of the value coming from US equities. So that's 66% more than the average investor in US stocks. The third category, which is one of the biggest differences, is crypto is featuring much higher. So 5.8% of the average portfolio value is coming from crypto. And to put that in perspective, that's a 45% increase on the average Australian investor portfolio. Coming in at fourth, which is very surprising, is ETFs and managed funds. So that's 59% less of the value coming from ETFs than what the average Australian investor holds. So it's really interesting that the top 10% difference is they have way more value in US stocks and a lot more value in crypto than the average Australian investor. Now, if we look at the types of holdings that the top 10% hold, we have 90% of all investors hold stocks, which is not surprising, and that's 84% hold stocks in the top 10. So pretty similar. Where it starts getting different is the ones who hold ETFs or funds. 71% of all investors hold ETFs or funds, but only half of the top 10% portfolios hold any ETFs or funds. Now, that's a very interesting difference. And then further down, so 16% of investors hold crypto, whereas in the top 10%, 30% of investors hold crypto. So a 14% increase there, which is really interesting. Coming down to the portfolio size, the average portfolio size in the top 10% of investors is $818,000. So that's up on the average of $671,000 from the average Australian portfolio. Now, let's look at the portfolio size brackets because this looks really interesting. So under 50,000 actually achieves the greatest average return here of 55% per annum over 5 years. Can you imagine your portfolio increasing in size by 50% for 5 years? That is outrageous. And that's 21% of the top 10%. So 1 in 5 portfolios is under 50K. Now, as we move down, the one that's really interesting is, again, the portfolios over $1 million are doing a 53.6% per annum return. Now, that is just mind-boggling to me. Imagine having a $1 million portfolio increasing by 50% each year for 5 years in a row. That's some outrageous value. And I would suspect in some of those portfolios, you'd find things like Nvidia and some of those, maybe Monster Energy, some of those companies that have just gone crazy high. They'll feature a bunch of crypto in it for sure, but we'll find out in a second. Coming down to the domestic versus foreign shares allocation. So in the top 10% of performance, we can see domestic only, so people invested just in the ASX, is 37%. That's a high number, I think, for people who are domestic only in this category. Then it starts dropping off, so people are mostly domestic, so that's 70% or more. It's 23% of people. The mixed people is 17%. Now let's look at the performance analysis of buy and hold investors versus active traders, but in this top 10% category. Now, what we can see was really surprising to me. There's basically no difference in average return. So buy and hold investors did an average of 47.7%, and active traders did an average of 48.1%, so pretty much exactly the same. Again, I would bet that the active traders paid a lot more tax and came away with a lot less real money. But in saying that, it seems like trading style doesn't matter too much in this top category, because either one of these types of investor are very honed in on what their strategy is and what they're doing, and they're achieving these big returns. Now remember, these are per annum returns. So this isn't a portfolio just went up 48% one year. It's they achieved that for 5 years in a row, which is extremely impressive. Warren Buffett himself was only in the 23-26% per annum. He did do it for 50 years in a row though, but these people are doing it 5 years in a row, which is still quite impressive. So the portfolio composition, stock focused portfolios, so more than 70% in stocks, that was 62% of the top 10% portfolios with an average return of 46.4. The diversified portfolios, so 30 to 70% in stocks and the rest in funds, crypto and that kind of thing, it was only 17% of the top 10%, and they did a 40.4. And then portfolios who were heavily invested in crypto, which was 21% of investors there, they did an average return of 52%. So I think there'll be some wild crypto gains in there, giving that huge return. Now we get to the big reveal. What did the top 10% average over this 5-year period? So to be in the top 10%, you needed at least a 26% per annum return. So we're talking Warren Buffett territory here. And the top 10% averaged 47.9% per annum over the last 5 years. I keep going on about it, but by anyone's measure, that is a crazy good return. I would be extremely happy if I was in that category. Unfortunately, I'm not in the 47% average category. And so that top 10% breakdown, that was across 268 portfolios of Australian investors. So they did 3.4 times better than the average investor, with an average portfolio size of 818,000. The average Australian Navexa customer is beating the market, which is really cool. And I'm really happy for all of you who are achieving that kind of return. So that was a 14.1% per annum versus the roughly 8 to 10 of the ASX 200. Buy and hold investors destroy active traders most of the time. So yes, the top 10%, it was pretty equal, but for the average investor, buy and hold strategy seems to be doing a lot better. Interestingly, ETFs and funds were quite absent from the top 10%. So it looks like they're finding very specific companies they're investing in or crypto they're investing in and making these huge wild returns. And we also saw that bigger portfolios perform better. And again, I'm not surprised by that, because the more money you have invested, the more serious you are about it, and the more you're going to watch your basket of eggs quite carefully. So the last takeaway we can get from the top 10% of investors is they're taking very big concentrated bets on a few things and making huge returns from it. High risk, high reward. A lot of people go with the opposite strategy of just investing in index trackers. They get the average of the market, so highly diversified, lower reward. It's no surprise to me that the best investors throw that strategy out the window and are going after a few crazy bets. I'm one of them. I'm all in on my own business, Navexa, so I'm not surprised other investors are taking a big bet on companies they believe in as well. So let me know in the comments if you liked this style of video and what kind of data points you'd like to look at in future videos. We're going to break down some of these strategies. Hopefully we'll get to talk to some of these people in the future. See you in the next video.